our podcast, Keeping It Real. People have this perception that this money they're invested or saved for themselves is somehow disappears. This is why they think of it as an unnecessary expense.
Banks are there to provide you credit so then you can get into further debt so then they can make money. He went from making nothing. It had been sitting there for a really long time, literally not growing, right? To now making 18%. Understand this. We do not make money unless you are making money.
Yes.
That is the biggest difference between institutions and independent brokers. Listen, people, I'm gonna claim myself to be selfish. I am a selfish broker because I want to make as much money as I possibly can.
Welcome to our podcast, Keeping It Real, where we talk about real financial problems with real people and really bring up real financial solutions. My name is Irene Meyer.
And my name is Phillipe Villanueva. Welcome, everyone, to today's episode. In the last episode, we talked about how GICs, TFSAs, RRSPs, high interest savings are used and misused, right? And we did a comparison talking about each and every single one of them and how they differed. Today, we're going to follow that money because once you see where your dollar really goes, you'll start to understand why banks push certain products and why independent brokers approach things a little differently. Okay, so keep in mind your money. When and Irene, you'll probably attest to this. People sometimes feel like, especially when you know what it is when people are first starting out and they've never really done a lot, they feel like their money is disappearing.
Yeah.
Right? And it changes hands. Now it's not, but the big question is whose pocket does it end up in?
Yeah, that's a really good question. You know what's interesting? For the very first time, you just really sparked a question, because being in the bank for 20 years and in the financial industry for longer than that, you're right. People have this perception that this money they're invested or saved for themselves is somehow disappears. So this is why they think of it as an unnecessary expense, right? Because they don't have immediate use for it or function, or they don't immediately have access to it in some cases they perceive. And but bring up the question of where it goes, hopefully it doesn't make them feel worse about it at the banks, because I think it will. Like I truly think it will. So I think bring this up really will open up the eyes to how and maybe who you're trusting with your money. So I mean, like I said, being in the bank for over 20 years, I never really understood how banks made money until obviously I was a manager and I had to start paying attention to the numbers. And I hope most of you guys know, and I think most of you guys know, banks are a for-profit entity. They're there to make money, which is why they're, invest in the banks, by the way, invest in the financial industry if you can. But they're designed to make money, but make money from the people who, bring money to them, which could be in the form of investing your money or just bringing your paycheck to them, right? So they're designed to make money for themselves and their shareholders, let's face it, not for necessarily the clients that bring them their money. Does that sound right, Phil? You've done a lot of research yourself.
Yeah, absolutely correct. Banks are designed to make money from your money, not for you. That's right. That is their design. They're lenders.
Yes.
I often say to my clients, banks are there to provide you credit so then you can get into further debt so then they can make money.
Right.
Right.
Yeah.
That's the order of operations for them, right?
Yeah.
Hey, let's get you good credit, because they always want to push their credit cards and get you good credit, right? Because then you're going to spend more money on credit, right? Yeah. Getting yourself into debt. And oftentimes, how many of us, everyone put your hand up, how many of us have overused your credit card thinking, well, that's my money. People, you don't have that money.
It's so crazy. What, like that? Yeah, you're so right.
Yeah.
Well, I mean, I think a lot of us can relate to a company, like a traditional company where you make something, right? And to make something, you need the materials to make it. So let's put it into perspective so you understand. So what do the banks make? They make money for themselves. Well, how do they do that? Well, the raw material in this example, right? It's not steel or aluminum or whatever, it's your money. Your deposits are what you would consider the raw material. So they use deposits and investments to fund to your point, Phil, lending money to other people and making interest from these loans that they lend out to people.
Yeah, like things like, when someone gets a mortgage, or when you open up a line of credit, or all of these things, you think that the bank is helping you, right? By giving you money for a mortgage, giving you a line of credit, giving you a credit card, or giving you a loan, or things of this nature. No, they're giving this to you at higher rates of interest rates.
Right.
Keep that in mind. Okay.
Right. Yeah. And so when you think about just plain simple English with profit, right, they pay you 2% on this GIC you put into the bank. And then they lend it at 8. So their 6%, which is 8 minus 2, is literally their profit margin.
Yeah, I'll give you a scary example of something that I just spoke to a client literally yesterday about. A few years back, he went to the bank and wanted to set up an investment portfolio. Now, I don't know if, and you might have to explain this to me, because it's so far back that he doesn't remember how it got started, but they opened up a lira.
So he transferred his pension. So then he might have had it mixed up with something else. Maybe he thought locked in GIC. He thinks locked in retirement account, but see, okay, so maybe this is it. So the locked in retirement account, which is the acronym LIRA, is an actual term to describe a pension transferred to a retirement account for the client. But it's also, if you think about it, locked in retirement account, it's a basic term as well. So in his eyes, it's locked in. Maybe it was in the form of a GIC. Someone told him, yeah, it's a locked in RSP. But it's just describing his investment, but it's not an actual lira or locked in RSP based on the government term. Does that make sense?
Liras only are pensions when they're first like
the technical term. That's how the bank should be using that that jargon, if you will. But think about it. Right? Technically, if I have a GIC, I hope I'm not losing anybody, but if you are getting some value from this video, please subscribe to our channel, because we talk about this at length in different aspects of financials. Anyways, so if you think about it, if you have a GIC in an RSP account, you can also call that a locked-in retirement account. Do you get what I'm saying? So it's technically the same thing if you were to describe the type of investment, and then, of course, the vehicle it's in. Do you understand? So he might actually have it wrong if he doesn't remember a pension being transferred.
Right. Okay. So he had this sitting at the bank making nothing. Sorry. Like it was making nothing. Right. And this was a couple of years ago. I met with this gentleman. Right. And I transferred it over outside of the bank and invested it properly. He went from making nothing, like it had been sitting there for a really long time, literally not growing, right, to now making 18%. Now, so now keep in mind, people, it's never going to be identical. It's never going to be the same, because you would have had to literally do the exact same thing at the exact same moment to have that kind of a return, et cetera, right? But in a couple of years, this gentleman has made a considerable amount of money on this lira, where it was literally not growing at all for almost a decade, if not longer, right? So talk about, no correspondence with the advisor at the bank either. Like no one's saying to this gentleman, hey, listen, this isn't growing. We need to make adjustments here, because this might be what you're relying on for your retirement, right? Or this may be something, think about this. Yeah. This gentleman is now in his 40s. I think he had this in there, over a decade ago. So had it been growing, and we've talked about this in past episodes, time is a factor when it comes to investments. Totally. So, you want to have it sitting at length so that it can grow to this eventual retirement amount, right? But if it's not actually growing, if they're only paying you 2%, right, it's not going to grow very fast. It's not going to go far, right? Now, if it's since inception growing at 18%, and I'm using that term since inception because that's very, very important, that's a considerable difference. So when I talk about since inception, that means from the dawn of time. So when you started and opened this account, it's on average been growing at that rate of return.
Right.
Okay. Where a lot of times you're going to get a statement from an institution that says your current rate of return is 15%. Okay, well, the market's high right now. And guys, I want everyone to look at your statement that you've had from the banks and look at every single one of them. I guarantee you that there's going to be some where it's not showing any rate of return, and some that are saying you're currently getting this rate of return. And I'm going to tell you why. Because the market goes up and down. When it's down, and I've been seeing this consistently with my clients that show me their statements, when it's down, they're not telling you the rate of return. When it's up, they are. Right?
So you've noticed this.
I've noticed this. It's like, it's weird because I've been looking at statements. I'm like, how come it's not telling us the rate of return? Oh, because the market was down at that time, right? When I research it and look back, the market was down at that. So the banks aren't actually giving. Or if your rate of return is consistently down, they no longer give you that rate of return on their statements. It's really interesting. So
That is interesting.
yeah,
I never noticed that.
look people, look for that, because I've started seeing that more often now on the statements where they're not even putting the rate of return, because it's a lot of them are in the negative, to be honest, right now, right, with the bank statement, so they're not putting it in there. So again, it can have a spike, and then all of a sudden you're going to see I'm getting 15, and then you're going to think, oh, I'm getting 15% rate of return. No, that's for that moment in time. That's for that, maybe that month, maybe that past 3 months. It might have been like that, but not since the beginning. You want to know from the beginning, what's my return? And if it's not on your statement, you can always call your bank and find out what's my return since I've started this account.
Yeah, and they should be able to calculate that, people.
They'll know it. They just have to open your profile, and it'll be right there for them to see.
Or even if they didn't have to open up your profile, you can even figure it out yourself. Anyways,
Yes.
we're getting into a different topic and how to figure out your actual rate of return. I think that would be a great video. Yeah. Anyways, we're getting back into, how the banks make their profit. Coming back to, so you guys got it. They lend at 8%. They pay you 2%, right? Tell us a little bit about GICs, Phil, because I think maybe going into the types of investments, especially at the banks, how those work.
Oh, I have had some horror stories with GICs recently. Okay, so GICs, if you walk into the bank and say, hey, listen, I want to start investing my money, but I don't want to lose my money, right away, they're going to put you into a GIC. And let's face it, a lot of times too, the banks are going to automatically just put you in a GIC when you want to start investments. And the reason why is because the payout on a GIC, you're maybe going to get 1 or 2%, 1 or 2%. Yeah. They say guaranteed up to, and this is important, guaranteed up to 5%, right? Up to. Which means anywhere between 0 and 5, they're not lying to you. Right. Okay? They're not lying. You will not lose money. It won't go into the negatives, but it'll be between 0 and 5. And here's the thing, right? As you're trying to attain 5%, most outside investors are getting, like I told you, 18, 15, 12, 8, 10, right? So even if you lost to 2% at some point, you're still going to beat that 5% no matter what. And it's up to 5%. Yes. Right? So most of the time it's sitting between 1 and 2 on average, right? Now, here's the other part is you have to be careful because it's either cashable or non-cashable, meaning it's either locked in or it's not. If it's locked in, you're stuck at whatever the rate you're getting. And it'll tell you, the ones that I've been seeing lately are saying the maximum they're ever going to give you is 2%. It'll even say the maximum. It'll say you're going to get between here and maximum of this amount. And the ones I've been seeing is maximum 2%. And those are locked in for 5 years. Yeah. Right? They're locking you in for 5 years. If you try to take that money out earlier than that, you will be penalized. Yep. Okay. So here's the thing, people. If you meet an advisor outside of the bank and you're not happy because you've been in this GIC for 2 years now, and it's literally the same money that you've put in is all that's in there still, don't worry about that penalty, because if you invest it properly, the investment return is going to make you a whole lot more money than that penalty that they're going to charge. Okay. Yeah. So don't even worry about that. If your money's not making money, the whole point of saving money, investing money, is to make passive income. That's the whole point of, if you're not making passive income, put it in your pillowcase. Right? Why fund the institution? Because they're taking that, again, they're lending money, they're investing money, they're using the bank deposits for their business. Okay, so all the mortgage, all the lines of credit, all of that is being funded by you, right? With the money that you're investing. It's all being funded by you. So if you've got a mortgage with that bank, you're funding yourself from the money that you're either depositing in there or borrowing from them, right? Yeah. You're funding that yourself. Okay, so they didn't give you money for that mortgage. You're paying for it through your investments and through your banking. Just keep that in mind. So that's the GIC. When they consider it a safe product, sure, it's safe. You're never going to go into a negative, but you're never going to make money there either. Yeah. Right. So that's, it's safe if you want to consider that being safe. But if you're investing, the idea of investing, again, is to earn passive. Right.
And like investing in funds, right? The banks have their version of funds called mutual funds. A lot of you know about that. And mutual funds are great because if properly done, by the way, you are exposed to different companies, different industries, different demographics. So you don't have to be, Einstein to what we call diversify into these different things. And you have much more opportunity for money to grow. Whether you are a conservative investor or a very very aggressively growth-oriented investor, there are mutual funds or funds that are for everybody. But in the bank, be very, very clear, only some people are licensed to provide this fund advice to you. So the biggest thing that you need to understand is looking at the advisor in front of you and asking, are you licensed to sell funds? And if they're not licensed to sell funds and you're looking at long-term investments, find somebody that does. Wait for the next appointment for somebody who's licensed at the bank, because that person in front of you will only be able to sell you a GIC. Okay. So let's just get that very clear. So it really depends on who's in front of you. I guess the one thing you should know about mutual funds in the bank, like I said, there's a lot of great funds out there, and I used to work at the bank, so I know, is the fact that you're still paying to go to a physical location. Yeah, so maybe the fund managers are not in the banks, but the banks need to pay their staff, they need to pay rent. If they own the property, they still need to pay taxes on the property that the branch is in. They still need to get money from somewhere to be able to pay for all this for you to come into a branch to get advice. So you can expect that the MERs, as we call the management expense ratios, are probably going to be a little bit higher than maybe if you dealt with an independent advisor or broker, because they don't have a branch to turn on the lights on, right? You know what I mean? They can work off site, right? But you're going to the bank site, and the bank needs to pay for the employee that's selling you the mutual fund. So you can expect that the cost of doing business with the bank is slightly higher than dealing with somebody who's independent.
Now, in saying that though, Irene, if you were to say that to me, I would question you and say, well, Irene, aren't you getting paid?
You mean at the bank?
No, like as an advisor, aren't you getting paid?
I
Right?
get paid for the work I provide, right? Whereas when I was at the bank, I got paid for sitting there for 8 hours. Think about it.
Correct. So what makes a difference? You're talking about, the bank has to pay its employees and things of this nature for and that's why the MER, the management expense ratio is higher, but you're still getting paid for the services that you render from this client as well. So shouldn't the MER fees be similar? Like, you're investing my money, yes, Irene?
Yes.
Okay, but you're investing my money at some location, at some building, there's still something there. It's still going to a facility to be invested, right? Just like the bank, and they still have to pay they still have to pay the employees there at that facility and things of that nature, et cetera, et cetera, et cetera. And you still get paid to do the job that you're doing. So what's the difference between a bank charging MER fees and you having to charge MER fees when realistically the expenses should be very, very similar?
Well, to be honest, I don't offer bank products, and very rarely independents offer bank products. So if I think about the types of investments I have, none of them belong to any bank. In fact, they belong to entities that don't have branches like banks. So they don't have these fixed costs that are like, think about it. If you think about your own bank, there's a lot of banks out there. Green banks are all over the place. There's high overhead.
And I think you're nailing that nail on the head right there. You're not just funding that one location, people. You're funding the multiple locations that bank needs in order to function. Well, when you're talking about investment institutions, it's one location, a province or something like that. It's not every single corner you turn there's a location, right? That's the difference. And on top of it, and Irene's dealing this as independent advisors too, we're not just selling or promoting or investing one company's investments. We're able to look at all of them and say, okay, we're in this person's specific needs, what this person is trying to attain, where are they going to get the best return? Where the bank doesn't have that option. The bank can only sell their product and their investment portfolios. They don't have the option of outsourcing where we do.
Right.
So we can look, okay, if the person's riskier, well, this investment company would probably suit them, right? Because they have these portfolios that they carry that might have a higher risk, but the returns are amazing.
Yeah.
Right. Where, okay, this one's a little bit more conservative. This one has good returns on a more conservative profile. So we're not stuck using that one agency or that one investment company. We can move it around, right? So that's the advantage. And we can, if someone's really concerned about the management fees, well, we have investment companies that don't charge very high in investment, right?
Yeah.
And so we go there, and so we have many options where the bank, this is our fees. this is our portfolios, you're stuck. So
Yeah.
that's kind of the
Yeah.
difference.
Yeah. Yeah. And so, like, kind of leads us to, the model that we're both familiar with as well, the independent broker model, the independent advisor model, making sure that dealing with the right person. So we've talked a little bit about just questioning your bank, question your banker. Are they licensed, properly set up so they can provide you the best advice for you and your family? And then if you've decided to kind of get a second opinion from somebody who's independent from any bank at all, you said something really interesting earlier that I felt was really meaningful. I think people need to hear it.
Okay, so people, when you're investing money, right? Money doesn't disappear. It changes hands. The big question is, whose pocket does it end up in, right?
Yeah.
So dealing with an independent broker, okay? Understand this. We do not make money unless you are making money.
Yes.
That is the biggest difference between institutions and independent brokers. If at an institution, if you're not making money, they're still getting paid a salary.
Yeah.
With us, if you're not making any money, neither are we.
Yeah.
So we have a vested interest that you are making money. The banks, when they say we'll take care of you, that often means they're going to take care of your deposit for their lending department. Okay. When we say we're going to take care of you, that means we need to take care of your money so then we can make money.
Yeah.
That's literally the difference.
Yeah, yeah, 100%. And I mean, for some people, I don't know why. I've had this question before. What do you get out of this? Or how do you get paid, Irene? Right? Because they know that I'm independent. You don't work for the bank anymore. Okay. You don't work for the bank anymore. How do you make money by giving me all this good advice? They think I'm like Mother Teresa for helping them out. And I mean, I'm very honest. Like the companies that I feel that would best suit your needs are the ones that would pay me. You don't have to pay me, right? They're the ones that pay me if I'm able to. And again, think about it. I bring money to them. We invest it properly, right? Based on your needs, right? But I'm not going to introduce you to a company that's not going to make you money because it's not going to help me. And that's totally different at the bank, right? You can be a really crappy advisor and still have a job. So there's no incentive unless the bank tells you you need to sell this many GICs. Well, then guess what? They're going to sell that many GICs. That's to keep your job, right? For me, it's like my incentive is to help you.
Listen, people, I'm gonna claim myself to be selfish. I am a selfish broker because I want to make as much money as I possibly can
Yeah.
by making you as much money as you possibly, because I cannot make as much money as I can possibly make unless you are making money yourself. So as an independent broker, I am going to always search out the most profitable investment company for you. I am always going to search out the best product for you because the more you are growing, the more I am growing.
Totally.
That's the bottom line. I am going to be very transparent on my fees. I'm going to be very transparent on my commissions. Reason why is because the more transparent I am, the more you understand, the more comfortable you feel, the more you are going to invest. And the more you invest in these companies that are making you money, the more money, it's simple, the more money I'm going to make. It's a very simple equation, right?
Yeah.
It's a win-win. You make money, the investment companies obviously make money, and then I make money. But here's the thing. Here's the difference. I am the last one on that totem pole every single time. I am the last one to make profit on that totem pole. Where in the institutions, it's the other way around. They are making the money first and then everyone else after.
Yeah, yeah. They have to pay for their overhead. Otherwise, they can't stay open. Think about it. They need to take care of their fixed costs, which are the people that man those buildings, the utilities that keep the lights on. Like that's just plain business. Right. And the thing is that when we think about people like us, Phil, and I say like us because I don't think every advisor is like this, but we want to make sure we retain clients, not just, obviously to keep them earning passive income, but we also like the idea that we help people and we want to be referred to their friends and family. So we're going to do a good job. Not every advisor thinks of their clients this way. Again, we can go back and forth, but at the end of the day, you want somebody who's going to be taking your long-term needs not goals, because we all have these needs. We all get old. We all retire, right? You're going to need a different plan when you're 65. And if you're only 50 now, you're going to need a different plan. So if someone's not thinking that far ahead and just thinking about, well, I want to make you as much money as possible so that by the time you're 65, you have this money, right? If your advisor's not trying to reach out to you on a regular basis to talk about whether you want to, sit down with them or not, but if they're not making the effort to sit down with you or keep in touch or see if you're debt free, then you might need to find a different advisor who can keep that long-term focus for you. Because let's face it, you're not gonna. If you were gonna, you'd be an advisor yourself, like really, right? So keep that in mind when you're meeting with people who are trying to help you with your finances, is see how long-term focused they are. Ask about, how often do you meet with your clients? If they're not even presenting proper protection for your family, they're not at all thinking about your long term. Like they may not even be insurance licensed. So, but they can still bring it up. Do you have proper life insurance? They can still bring it up. They don't have to talk about the details, but they can ask, do you have protection for your family? And if they don't ask that question, then they're not looking at you as a long-term relationship.
Yeah, it's very, very important. The strategy, there has to be a strategy to why you're visiting me in the first place. If I was an advisor at the bank sitting there in my cushy little office, and you walk in and say, "Hey, I want to start some investments," my first question should be why.
Yeah.
What's your purpose, right?
Yeah.
But they don't, they're not doing that. They're like, come on in, right? What kind of investment do you want to start?
Yeah.
Right, that's typically the case. Like the question why is really, really important. And if they're asking you why, because they might have maybe a banker's watched our video and now they're saying, oh, I'm going to ask why from now on. Okay, if they're asking why, then there should be a carry on to that why, an actual plan being built off of that why, right? Not just asking for the reason of the purpose of asking, right?
Yeah.
Everything builds off of what your goal is, and they might even contradict your goal, right?
Yeah.
They're going to question your goal. If your goal is not, going to get you to a proper retirement, so then you can have a nice life throughout your entire living, then we're going to tell you that.
Yeah.
We're going to say, hey, listen, you might want to make some adaptations here. Right?
Yeah, we need to pivot a little bit.
A little bit, yeah. Right. You still want you to enjoy your family, enjoy your life, and do this and do that, but you might want to consider this.
Yeah.
Right? Now, Irene did say there are licenses for insurance and things like that. So here's the other thing is when you go into that bank, and Irene, you were a bank manager for many, many years. If someone came into the bank and spoke to an advisor, who's regulating what happens there? How is that being regulated?
So, I mean, there's the one thing I'll give the bank is they have to be regulated. Like we have audits in place, making sure the proper collaterals out on the shelves, the proper licensed associates have the proper collateral on the shelf. There'll be mystery shops about, what this licensed mutual funds advisor knows. They have to take a test. They have to pass the test. They get licensed, right? So there's those in place. I mean, there's always a branch compliance officer who's going to be overseeing the paperwork in the banks, but it's very basic. I mean, I don't know if it's changed in the bank, but while I was at the bank, there was no actual coaching involved with making sure this newly licensed advisor actually understands what they're responsible for. So I found many different mutual fund advisors who still didn't actually do what they needed to do to explain, for instance, past performance, MERs, right? And I mean, this is something done that was like a behind the scenes CBC, what the banks don't tell you actually, and maybe we'll put it in the show notes. You'll see that a lot of people will misconstrue what you can get with funds and make it sound like, it's guaranteed. And of course, the person in front of them doesn't know any better. And I mean, Phil has brought it up too. Like it's never about, past performance, but understanding this kind of performance for your investments do exist, right? And if you've never seen kind of the type of performance that, Phil was mentioning earlier, then that's the time to really talk about looking at other options, another advisor for your money. So I would say like there are things in place in the banks for sure, because they are regulated entities. They're very, very regulated by the federal government. Like they'll get in trouble if they don't follow certain things.
Now, do they get in legal trouble?
Oh
What do
yeah.
they?
They'll get
Okay.
fines. Yeah, they'll
Oh,
get
they're fine.
fines. And I mean, like that's why they stick really close to making sure their licensed advisors have the proper collateral. Like, I mean, again, like it's very basic. They
Mhm.
cannot have a video in everybody's office to really see how they present mutual funds, explain mutual funds, right? They just assume. And again, that's with everybody. Like, I'm not going to say that's only specific to the bank. I mean, we're all people. We all do our businesses differently. But I think maybe just as a consumer watching this video, I think the only thing, so you're not feeling overwhelmed, because I know some of you might be feeling overwhelmed, maybe even hit stop on the video already, because it's just a lot, right? I think just to make it simple for you folks who don't necessarily care about the back end part is really just making sure that your advisor has a long-term focus for you and your family. And I've given you examples of why and how you can determine that. And then understanding, if you want, understanding how your advisor gets paid.
Yeah, there was an episode done on Marketplace regarding
Marketplace.
where
Yeah.
Irene was talking about they can't put cameras in all the offices. Well, so Marketplace brought in a camera and spoke to
Mhm.
bank advisors, and it was a disaster. It was a
Yeah.
disaster, and that's something that independent advisors have always talked about. And
Mhm.
because we are very responsible for what we say to the general public, our regulation is very, very strict. And we are solely responsible because we are literally on a one-on-one with you, the client, in discussing and trying to make, again, full transparency. We have to be fully transparent with everything, even to the point of how we get paid. We have to tell you how we get paid. We have to tell you if there's any conflict with what we're telling you, in where what we're trying to do with you. We have to let you know that if there's any conflict right away, we can't mislead you in any form or fashion at all.
Yeah.
Where the advisor sitting at the bank doesn't have that weight on their shoulders so
Yeah.
much, and that was shown and proven in that Marketplace episode. Feel free to Google search that'll show up in YouTube. It's all over the place on YouTube. So I understand this. Banks are manufacturers, brokers are distributors. Okay. One sells what's on their shelf, the other finds what fits your life. Okay. Again, let's break that down to really simple. If you were going in to buy a car and they only had one car on their lot, that's your option. We'll call that the banks, right?
Yeah.
If you're going in to buy a car and there's 5 or 6 dealerships there, right? And that salesperson can represent all 5 or 6 of them, that's a distributor.
Yeah. Yeah.
Okay, so that's the difference. That's the broker. So that's the big difference.
Yeah. Well, I mean, the next time you sit across someone offering you a safe investment, guys, like ask yourself safe for who, right? Like follow the money as Phil kind of mentioned. These institutions have a business model. You just need to make sure that their business model doesn't become your retirement plan.
So people understand this, and I know we're doing a comparison. This is just a comparison. People, banks aren't the enemy, right? They're not the enemy, right? We need them. We, as an independent brokers, we need them as well. They just have different objectives. Okay, so we want to educate. Most Canadians never learn how the financial ecosystem really works. We're just educating you on that. The bank focuses on product, brokers focus on planning. That's the biggest difference, right? And the goal isn't to bash the banks by any means, right? But we want to empower your awareness. Okay, we want you to understand what's really happening out there, because most people, especially when you're starting out, especially that young 20-year-old, when they're first starting out, they don't know any different. The first thing they're going to do, because their money's in the bank, their checking account, their savings accounts in the bank, whatever. That's where they're going to go when they think, I have to start investing, or I want to look at other options. First thing they're going to go to the bank. So we need you to understand what that really curtails when you say, oh, I'm just going to go to the bank and talk about this stuff.
Right, right.
So
Well, thanks for joining us today. I hope you guys got value from this segment.
if you guys like what we're talking about here, and we're trying to keep it real, that's the name of our show. I'm keeping it real. People, we are trying to keep this as real as possible for you. Please like and subscribe to our channel and pass the word. We want everyone to know and have an understanding of what is happening with your money.
Yes. Have an awesome day, guys.